Morning, everyone. Um, so with the current breakdown of the study units that we need to cover for 2023, I'm checking the study guide that has been uploaded by the lecturer. So you will see that on the study guide, they have, let me just highlight it on the book now. So you see that on the study guide, they have broken down the study units into different topics, where the first topic looks at introduction. Then the second topic looks at firm or obligor credit risk. Then the third topic looks at credit portfolio risk and mitigants. And the fourth looks at credit risk, project, and working capital. Then the fifth and last topic looks at the line of defense, which is basically looking at securities as well. So you will see that all these topics, they are covered in the book C.B. Joseph, but there are some sections where the lecturer says there's another book that we need to be able to utilize, the other two books that we need to be able to utilize as well. So to avoid any confusion, what we're going to do is that using the videos of the previous years that we've done, we are going to rearrange the videos, because remember, all these topics, they are basically covered in C.B. Joseph. So what we're going to do is that when we look at the previous historical videos, we're going to rearrange the topics for Rsk4804 and arrange them based on the different topics and based on the different learning units that we're going to be expected to cover as well. So you'll see that when you open your page on Tuesday, from Tuesday onwards, the pages are going to be arranged exactly according to the topics that are going to be covered, and also the study units that are going to be covered as well. So they're going to be slightly different, because if you look at the study guide of what was used previously and what we're going to be using this year, they've basically rearranged the study guide, but the topics or the chapters which are covered, they are still the same, but they've basically rearranged them. And what they've gone over and above to do as well is that they have also referred us to certain topics from the other two textbooks as well that we're going to be able to utilize according to the different learning units. So how we're going to approach it this year is that when we look at material from previous year, we're going to rearrange it according to the new sequence now. And what we're also going to do now is that this year we're also going to cover not only material coming from C.B. Joseph, we're also going to cover material coming from the other two textbooks as well, so that you can see exactly how it's covered in the other two textbooks, so that we were able to comprehensively cover the different chapters which are expected to be covered as well. So you also see that our platform, when it comes to Rsk4804 from Tuesday onwards, is going to be different from how it was previously, because previously we were just concentrating on C.B. Joseph. So what we're going to do now is that the chapters in C.B. Joseph, which are relevant, because the chapters that are covered in C.B. Joseph, they are still relevant to the chapters that are also going to be covered under these different topics as well. So we are going to simply rearrange these chapters from C.B. Joseph. And then what we're also going to do is that we're going to also add on the chapters which are also going to be coming from the other two textbooks as well, so that we're able to cover the material comprehensively. So you will see that from Tuesday onwards, the platform for Rsk4804 is going to be different, because we have to arrange it according to the sequence that the lecturer is going to be putting here, so that you understand exactly how we are based on our progress on when you compare that with the study guide. So we're going to start everything from learning unit 1 according to the study guide going forward as well. And so you will see that some of the chapters that are covered in C.B. Joseph, they are also coming in, but how they are coming in now is not necessarily in the same sequence as they're given in C.B. Joseph. So you see that some chapters, they refer to chapter 2 of C.B. Joseph, so then you go to chapter 6 of C.B. Joseph, then you go to chapter 8 or chapter whatever as well. So you'll see that the sequencing is going to be different from Tuesday onwards, although the material is more or less the same as well. So are we on the same page when it comes to our platform and how we're going to approach this module going forward as well? So the sequencing is going to be different. We have to choose the sequence, because if you look at the sequencing for this year as well, you see that the sequencing is basically different. Reason being, they've basically rearranged the study guide, and then they've put in more emphasis on us covering the topics from the other two textbook as well. So because of this, we need to we also need to incorporate the material from the other two books into our study units, and we also need to make sure that we rearrange the units not necessarily as they are given in the sequence there. So you see that we're going to be rearranging them according to the study guide on exactly what is expected of us as well. So you see that on the study guide, there are about 12 learning units that we need to make sure that we cover. The first one looks at credit risk analysis and management. Then the second one looks at industry risk. Then the third one looks at rating and scoring systems. Then expected loss given defaults and measuring probability of default. And then the fifth one looks at integrated view of firm level risks. Then the sixth one looks at financial risks. Then the seventh one looks at credit derivatives. Then major portfolio risk and assessment of credit risk. And then we look at credit risk validation of models and Basel codes. Then the 10th one, we look at credit risk in project finance, and then credit risk in working capital. Then the 12th one looks at credit basics, collateral, and covenants. Remember, all these topics, they are already, the videos covering these topics, they are already there already. The only difference now is that this year, we're going to rearrange these videos. So we are going to be rearranging these videos. Then over and above that as well, we're going to be incorporating material coming from what? Coming from the other two textbooks as well. So that's basically how we're going to be approaching this. So you see that there's going to be 12 learning units. We're going to cut it down to 12 learning units. But within these 12 learning units, they are basically now taking material from taking this chapter. One learning unit will be covering this chapter and that chapter, and another learning unit will be covering different chapters as well. So we're going to be rearranging the platform for RSK4805. Are we on the same page when it comes to RSK4804? Any questions? So looking at that, if you check in the study guide that was posted covering learning unit 1, right? If you look at the study guide that was posted covering learning unit 1, you see that for learning unit 1, they for 1.1, they look at the purpose where they say to understand credit risk in entirety, including processes, credit management framework, and credit risk analysis and challenges. Therefore, then they give us the key concepts that we need to make sure that we take note from that. Then they give us the learning outcomes. Then for learning unit 1, they're basically saying that for learning unit 1, we need to cover these chapters coming from these 3 books, right? So for learning unit 1, we need to cover the chapter coming from chapter 1 of, remember this Bandyopadhyay, this one is basically the one that is the textbook, which is written managing portfolio credit risks in banks. Then they also ask us to look at the Whitney as well, and this is basically the book that looks at credit risk management, pricing, measurement, and modeling as well. And remember these books as well, if you check under risk management textbooks, where you are able to download these books. So the books are already there. I already shared them. So you are able to download these books under risk management books as well. Remember, they're already there, but we're using them in support of the material that was being covered in CP Joseph. So which basically means that now that we're going to be looking at this material, these chapters on their own as well, it basically means that we're going to be specifically looking at this material specifically in the book to see exactly how are they covered and exactly how are they going to be able to be relevant to the new to the way that the study units have been arranged as well. Then they also ask us to look at chapter 2 of CP Joseph as well. So looking at this, you will see that going forward on unit 1.4, they look at, they say, credit risk is the potential that a bank borrower or a group of borrowers will fail to meet their contractual obligations and the future loss associated with that. So furthermore, it might involve investments deteriorating in quality or going into default with the consequence loss to the bank. So it is therefore crucial that people with relevant or necessary skills and techniques be employed to enable proper assessment of credit risk. So a firm must put in place quality credit risk analysis structure to ensure a clear understanding of the real risks involved when extending credit, and which then should be priced appropriately, which is basically according to CB Joseph as well. And based on this, they say, when you look at the introduction of credit risk, they say you have to work through chapter 1 of the prescribed book, which is basically which is basically the other book that we discussed, with special attention to the credit risk drivers, borrowers' level risks versus portfolio risks, management of credit risk in banks, role of capital, that is the difference between regulatory capital and economic capital, then credit risk management framework, and then they say up page 13, and factors affecting credit risk. Then any additional information relating to the topics must be sourced individually to add your knowledge as well. So that's basically the book that the chapter that we need. That so we need to go. We need to look at the first chapter of this particular book, so that we're able to cover these key concepts as well. So which means to cover unit section 1.4, if we look at the textbook. So if you look at the textbook, so if you look at the textbook that we need to look at, which is basically covering chapter 1, is where we look at chapter 1 of so in this case, we're going to be looking at chapter 1 of so in this case, we're going to be looking at chapter 1 of managing portfolio credit risks in banks. That's basically by Arindam, right? So that's the author of the book. So it's going to be coming from managing portfolio credit risk, which means that since now we're going to be moving according to the sequence of what they're expecting us to cover, according to the study guide, because they're now placing more emphasis of us covering the material from the other textbooks as well. It basically means that we're going to be moving according to the study guide as well. So which means they are asking us to look at chapter 1 of this book, which looks at introduction to credit risk as well. So looking at that, they say credit risk is the potential that a bank borrower or a group of borrowers will fail to meet its contractual obligations and the future loss associated with that. So for most banks, loans are the largest and most obvious source of credit risk. However, the other sources of credit risk exist throughout the activities of a bank, including the banking book and trading book, and both on and off the balance sheet. So banks are also increasing facing credit risk in various financial instruments other than the loans, including acceptances, interbank transactions, trade financing, foreign exchange transactions, financial futures, swaps, bonds, equities, and options, in the extension of commitments and guarantees, and the settlement of transactions. So since the exposure to credit risk continues to be the leading source of problems in banks worldwide, banks and their supervisors should be able to draw a useful lesson from the experiences. So banks should now have a keen awareness of the need to identify, measure, monitor, and control credit risk, as well as determine that they hold adequate capital against these risks and that they are adequately compensated for risks incurred as well. So now, when it comes to credit risk of the, that is when you look at it from the bank's perspective, we're basically saying, when you look at banks, the accounting equation of the bank says your assets is equal to equity plus liabilities. And in this case, the equity is the ordinary share capital that has been contributed. So in most cases, we just simply refer to it as capital, although this can also be seen as capital, but we are going to be saying capital. Whenever we refer to capital, we're referring to the ordinary share contribution and any other source of what financing that has been contributed by the owners of the bank as well. So whenever we talk about capital, we're referring to the contribution by the owners of the bank, in most cases, in simple terms. Now, when it comes to banks, this is from the assets of the bank. This is where they seek to generate income and returns. So this is basically where the bank seeks to generate returns. And how do they generate returns? They can either invest in securities. So they're going to be either giving out loans, or they're going to be investing in different securities as well. And remember, these different securities are very wide-ranging. And why are they doing this? It's mainly because they are seeking to be able to generate a return, right? Now, when you look at the financing of the bank as well, in simple terms, this is where we look at either debt financing that the bank is going to be getting, where the bank can borrow money. So that's basically through debt financing. But a very important aspect of financing for the bank as well is where the bank gets money from depositors. So now there are different risks that the bank is going to be facing in its operations. So we're not only going to be worrying about the risk that so when it comes to the different risks over and above credit risk, which is what we're concentrating more on when it comes to Rsk4804, there are so many other risks that the bank is going to be worrying about having as its risk exposure as well. Like, for example, it can be a market risk, it can be operational risk, it can be legal risk, it can be so many other sources of risk that the bank is going to be facing as well. But in our case, we are going to be worrying more with regards to credit risk, which is basically what we are looking at when we look at Rsk4804. So for Rsk4804, we're acknowledging that there are so many other different types of risks that the bank is going to be facing, but the one source of risk that we're going to be more worrying about or concentrating on is credit risk. Although we know that there are so many different types of risks that the bank is going to be facing as well. So now we're going to be saying, how do we ensure that we mitigate this credit risk when the bank is in pursuit of what? Generating returns. So how do we make sure that the bank it's in pursuit of generating these returns, is able to mitigate the effect of credit risk? So that's basically what we're going to be concentrating on in Rsk4804. So which means the credit risk now, as you will see, let me see if we have covered it already. As you will see, this is basically where we're saying that this is basically the risk that the obligors are going to end up defaulting on their obligation. So that's basically what we look at when you look at credit risk. You're basically saying that we're acknowledging that with credit risk, you're basically saying that this is the risk that the obligors, if it's our loans, our customers are going to default on their loans. If it's securities, it basically means that wherever we are invested in there's going to be default or not in those securities, which basically means what? There's going to be losses from the securities that we're going to be investing in as well. So when you look at credit risk, we're basically saying, if there is going to be losses here, if there's a potential that there's going to be losses here, how do we ensure that there is enough capital here to absorb these losses? So how do we ensure that these losses that are coming, remember with the balance sheet, whatever is happening on the left side affects what is happening on the right hand side. So if there's going to be potential losses here, how do we ensure that these losses are going to be absorbed there's going to be enough capital to absorb these losses. Why are we worrying about having enough capital to absorb these losses? Because we don't want to end up affecting these other ones. Because if these ones are affected and we're not able to meet their obligations, what is going to happen? This is where you find that there's going to be, the bank is going to be forced to close down its operations. So as long as the bank is not able to meet this, then it basically means that there's not enough money to absorb these losses, and the bank will have to be forced to cease to operate. So for the bank to be able to operate there, they need to make sure that there's enough capital here available to absorb these potential losses from the income generating activities of the bank on this left side of the balance sheet. So are we on the same page when it comes to the overall picture when it with regards to credit risk management from the bank's perspective? Are there any questions? So moving on. So here they say, by definition, credit risk is the risk resulting from uncertainty in the counterparty's ability or willingness to meet its contractual obligations. So credit risk relates to the possibility that loans will not be paid, or that investments will deteriorate in quality or go into default, with consequent loss to the bank. So when we talk about credit risk, we're basically saying the contractual party who fail to meet their obligations, whether it's loans or whether it's securities that the bank is invested in. Are we on the same page? Any questions? So please make sure that you take note of the definition of credit risk in this case. Please make sure that you take note of the definition of credit risk in this case. On the next section, we look at the major drivers of credit risk. And yet they say, credit risk arises because in extending credit, banks have to make judgments about a borrower's creditworthiness, its ability to pay principal and interest when due. So this creditworthiness may decline over time due to change in its financials, poor management by the borrower, or changes in the business cycle, such as rising inflation, recession, weaker exchange rates, and increased competition as well. Now, when you look at the major drivers of credit risk, the first one that they discuss in this case, they say the major drivers of credit risks are the first one being default risk. And here they say, when you look at default risk, this is where the obligor fails to service debt obligations due to the borrower specific or market specific factors. And the second major driver in this case is recovery risk. And in this case, this is where they say recovery post default is uncertain as the value of the collateral changes unexpectedly. Now, when you look at recovery risk, we're basically saying when default happens, two things are going to happen. When we say default has happened, it basically means that we're basically saying that the customer is either failed to repay the principal amount or they failed to repay the interest when it falls due. That's when we say default has been triggered. So when that happens, now there's going to be two possibilities. It's either we're going to be able to recover something from the money that were being owed by the customer in total. It's either we're going to recover something or we're not going to be able to not recover something. So which means whenever default is triggered, two things are going to happen. If either there's going to be a portion that we're going to recover, or there's going to be a loss given default. So when default happens, we might end up losing out on this. So which basically means that what also affects the recovery rate as well is the recovery rate. Is basically where we're basically saying that if the customer has put in a particular security or a particular asset as collateral as well, how much of this collateral have we been able to utilize to recover the amount that is still outstanding? And if there's still going to be some amount which you are not going to be able to recover, then there's going to be a loss given default as well. So which means default, whenever there's a default situation, two things are either going to happen. It's either we're going to recover some of the amount outstanding, or there's going to be a loss given the default situation as well. So which means in this case, when they talk about recovery risk, this is the risk that we're not going to be able to recover the amount that is outstanding as well. So it's basically another driver of credit risk. And the second one is spread risk, where they say credit quality of obligor changes leading to fall in the market value of the loan. So the credit quality of the obligor changes leading to a fall in the market value of the loan, which means in this case, when the credit quality of the obligor goes down, the market value of the loan is also going to go down, because we're basically saying when the credit quality of the obligor goes down, the loss given default is expected to increase, because it's always going to be a seesaw. It's either you recover something or you lose something. When you recover more, you lose less. But when you lose more, you end up what? When you recover less, you end up losing more as well. So when it comes to this particular spread risk in this case, we're basically saying that when you now look at the spread risk, where you look at analyzing the credit quality of the security as well, of the credit security, we're basically saying, in this case, when the credit quality of the obligor goes down, it means that the probability that the loss given default is going to be increasing is high. And because of that, it basically means that the market value of the loan is expected to decline as well. Another driver of credit risks is concentration risk. And when you look at concentration risk, they say this is overexposure to an individual borrower or group or entity or segment as well. So this is basically where you look at concentration risk. So when you look at concentration risk, we're basically saying, as an entity, the more the amount of money, if let's say, for example, in simple terms, if it's loans, right? If it's loans, when you look at concentration risk, let's say, for example, we have Bank A. Bank A only has 2 customers. They gave out a loan of 50,000 to customer A. Let's say customer X. And then they gave out a loan of 50,000 to customer Y. So of the 100,000 that they're being owed, they only decided to give out only 2 loans to customers X and customer Y. So which means in this case, 50% of their portfolio is in customer X, and 50% of their portfolio is in customer Y. So do you see that if customer X defaults on their obligation, it means they have a high risk exposure, that it basically means that they are going to be highly exposed when it comes to their losses. Because remember, the amount that is going to be exposed to potential losses in this case is 50,000. But now when you look at bank B, bank B is going to be having customers E, where they give out 10,000, F, where they give out 10,000, G, where they give out 10,000, H, where they give out 10,000, I, where they give out 10,000, J, where they give out 10,000, K, where they give out 10,000, 2, 4, 6, 7, L, 10,000, M, 10,000, N, 10,000 as well. So it's 2, 4, 6, 8, 10. So bank B has 10 customers. So instead of having just 2 customers compared to bank A, bank B is going to be having 10 customers. So as they're having 10 customers, it basically means that if customer E defaults on their obligation, it means the amount of their total portfolio that is exposed to risk is only 10,000. And here, if customer X for bank A defaults on their obligation, the amount of their risk exposure that is exposed to default in this case is the full 50,000. So do you see now what they mean by exposure, concentration risk? So concentration risk, they're basically saying that the more a bank is concentrating giving out credit to a few customers, the higher the risk that they are. If one customer defaults, their whole book is going to be badly affected. So one way of avoiding concentration risk is where they can diversify their book, where they're not just giving out loans to a few customers, they're basically giving out loans to more customers. So the more the customers the bank is giving out to, the lesser the risk, because in this case, 50,000 is their risk exposure if one customer defaults. And in this case, only 10,000 is their risk exposure if one customer defaults as well. So that's basically what they mean by concentration risk. So when you're comparing bank A and bank B, we would say bank A has a high concentration risk as well when you're comparing the two banks as well. Are we on the same page? Any questions? Next, we also look at correlation risk as well. And here they say, common risk factors between different borrowers, industries, or sectors may lead to simultaneous defaults. So in this case, we're basically saying, when you look at correlation risk, the correlation coefficient varies between -1 and +1. So the correlation coefficient varies between -1 and +1. When the correlation coefficient is at +1, we say the two variables are perfectly positively correlated. Which means if you are looking at, in simple terms, let's say you look at two investments. Let's say the bank is invested in two investments, right? investment M and investment N. We're basically saying when the correlation coefficient is at, so correlation risk basically comes in during the back periods, where if the bank's book is invested in investment M and investment N, during that period where investment M is not doing well, if they are perfectly correlated, it means investment N is also not going to be doing well. So this is basically what they mean by correlation risk. So which means the correlation risk basically increases the more you go this direction. So correlation risk increases the more you go in this direction. The more correlated, positively correlated your two investments in the bank's book are, the higher the correlation risk. Ideally, you would want a correlation which is something close to -1. Because if it's close to -1, we say it's perfectly negatively correlated. So we say it's perfectly negatively correlated, which means in this case, if two investments are, let's say you have investment M, which is moving in this direction. If they are perfectly negatively correlated, it means when one is going up, the other one is going down. So it's something like this. So which means in this case, we are saying our correlation risk is mitigated because when one is having a good investment period, the other is having a bad investment period. So which means the net returns are going to be netting off each other, which means you're not going to be overexposed to those periods of what bad investment returns over time as well. So which means what you need to take note of is that when you look at correlation risk, know that when you look at two securities, the more the correlation coefficient is closer to +1, the higher the correlation risk as well. Are we on the same page? So you need to check to see what is the correlation coefficient between the two investments of the bank. If the two investments of the bank are having a correlation coefficient closer to +1, the closer they are to +1, the higher the correlation risk as well. Are we on the same page? Any questions? Anyone lost? Moving on. So these are the major drivers of, so these would be the major drivers of credit risks as well. Is there any question regarding the major drivers of credit risks? Any questions?
Hi, yes, sorry. Yes, can you kindly explain again the graphs under correlation risk, please?
Explain what in particular?
The graphs, the impacts using the graphs.
So
yes,
when you look at the graphs, we're basically saying when the correlation coefficient, remember they're talking about correlation risk. So the basic idea is correlation coefficient varies between -1 and +1. You never find the correlation coefficient which is here or which is there. It's always going to be found in between these two values. And what you need to take note of it as well is that the more the correlation coefficient moves in this direction, the correlation risk is also increasing. So the more closer you are to +1, the higher the correlation risk. So what you mean by correlation risk is that we are saying when they are perfectly positively correlated, we're basically saying when one goes up, the other one goes down, up. And when one goes down, the other one goes down as well. So that's when we say investments are perfectly correlated. Where we are saying that they're basically mimicking each other. When one goes up, the other goes up. So if you have two investments in your bank book, and you see that these two investments, when one goes up, the other goes up, and one goes down, the other goes down. What is happening there? It basically means that when you talk about correlation risk, we're basically saying it means the bank is likely to have huge losses during those downward periods. Because remember, over time, if the returns of asset M starts going down, what is going to happen to returns of asset N? They're going to go down as well, isn't it? Remember, we're saying our accounting equation says your assets is equal to equity plus liabilities. And we said equity is the capital that is needed to absorb the losses, isn't it? So during those periods where we have huge losses, when you talk about correlation risk, we're basically saying it means our losses are also going to be so big that we might not have enough capital to continue running as a bank as well. So which means as a bank, we need to make sure that we try to mitigate and reduce this correlation risk as much as possible, because we don't want to have a situation where in some periods when this investment goes down, this one goes down. And the risk is that we might not have enough capital available to mitigate the losses that are arising from the what? Downward trends in returns. Are we on the same page now?
Yes, thank you.
So the whole idea is we need to make sure that we have enough capital to cover these losses so that we're able to ensure the bank's continuity. But if we don't mitigate this correlation risk, what is going to happen? During that period where we have losses, if we have two assets in the bank or two assets in the bank that we're invested in, if this asset starts having losses and this one also has losses, what is going to happen? Our losses can end up being too catastrophic that we might not have enough capital to continue as a bank, hence correlation risk. So ideally, we want to find the correlation risk to be as low as possible, closer to -1. The correlation coefficient to be as low as possible, closer to -1 as much as possible. Are we on the same page? Any questions? Anyone lost? Can you move on? All right, moving on. On the next section, we look at the factors affecting credit risks. And here they say, factors affecting credit risks are as follows. And when you look at the breakdown of the factors affecting credit risk, they say expected and unexpected losses arising out of adverse events are as follows. So when you look at factors affecting credit risk as well, it's a bit difficult to explain this because in CB Joseph, when you look at this, you're basically looking at this in a more sequential form. Now, when we're talking about factors affecting credit risk, it's going to be very difficult for me to now start explaining expression before so that you're able to see exactly where it's coming from as well. But ideally, this is what we're saying. Looking at the factors affecting credit risk, we would say your expected losses so your expected losses are a factor of a factor of exposure at default multiplied by probability of default multiplied by the loss given default multiplied by your term to maturity. So this is basically what affects your expected losses. And we need to account for the expected losses because this is what we're going to be using as a factor in determining exactly at what price we are going to be charging a particular customer as well. So take note. I'm just going to deviate a little bit from there. You will see that if you still remember from your undergrad, we said when you're doing your undergrad, we said your nominal rate of interest is given as the real rate of interest plus inflation premium plus risk premium. And then we said this is your risk-free rate of return. So your nominal rate of interest is given as your risk rate of return plus risk premium. So this risk premium is basically the risk that we're basically saying that you're going to be basically taking in case of what? In case of that will result in what? In default by the customer as well. So which basically means as well that this nominal rate of interest is the interest rate charged by the bank, isn't it? So this nominal rate of interest is basically the interest rate that is charged by the bank. So this interest rate that is charged by the bank, that's the what? Price of credit. So when one risk premium. So which means the expected loss is one of the factors that is determining the risk premium so that they know exactly at what pricing they're going to be charging customers as well. So which means what would affect the expected losses is your exposure at default, which shows you exactly how much is owing at the time of default. The probability of default, which shows you exactly what is the probability that the customer is going to be defaulting on their obligation. And then the loss given default is basically saying that in case of default, what percentage of the amount owing are we expecting to lose? And then the term to maturity is basically saying how many years do we have left before the loan reaches maturity as well. So these are the factors that affect the expected losses. So looking at these factors, remember we're saying they affect what? The expected losses, right? So which means if these are the factors that affect the expected losses, now we're going in detail to say, so what is the exposure default? What is the probability of default? And what is the loss given default? And basically, what is the correlation between the different loans as well? That also affects what? The expected losses as well. Are we on the same page so far? Any questions? All right, I had load shedding. I'm just reconnecting my laptop now. All right. We can continue. I had a bit of load shedding, but we continue now. I'm reconnected. So these are the factors that affect your expected losses. So now we're going to be looking at these factors in detail to say, so what is this? What is this factor and what is that factor as well? As they contribute towards what the expected losses of the entity as well. So looking at this, they say, so when you look at factors affecting credit risk, which is basically where we look at the expected and unexpected losses arising out of the adverse credit events, the first one that they talk about is the exposure at default, where they say the exposure at default is in the event of default. How large will the expected outstanding obligation if the default takes place? So the basis for the exposure at default is the outstanding and the external limit booked in the official process system. So the exposure at default is to be the estimated on transaction level from historical default information available in the bank. So when you talk about exposure at default, but basically in simple terms, we're basically saying, in case of the default, if we have default, in case of default events are happening now, how much is the customer still outstanding on their loan amount? So how much is still outstanding on the customer's loan amount? So that's basically what they mean by exposure at default. When it comes to the explanation of this, don't worry much about it. Just know exactly what the definition of exposure at default in simple terms is. So your exposure at default, you're basically saying, in simple terms, if default happens now, how much is the customer still owing, or how much is still outstanding on their loan amount? That's basically what they mean by exposure at default. So that's basically one factor that affects what? Your expected losses. The other factor that they discuss in this case is the probability of default, where they say, is the probability that the obligor or counterparty will default on its contractual obligation to repay its debt. So it is generally estimated by reviewing the historical default record of loans in a pool with similar characteristics, or from a temporal movement of gross non-performing assets from standard category of advances as well. So the probability of default, you're basically saying, what is the probability that the customer is going to be defaulting on their obligation? And one way of determining the probability that the customer is going to be defaulting on their obligation is where you're going to be saying, in which category or in which risk pool is this customer falling under? And based on risk that the customer is going to be falling under as well, you can now be able to determine exactly what will be the corresponding probability of default. And the next one is what they refer to as the loss given default, where they say is the percentage of exposure the bank might lose in the case that the borrower defaults. So usually it is taken as the loss given default comprises the fraction of exposure or at default which will not be recovered by the bank following default. So it comprises the actual cost of the loss along with the economic costs associated with the recovery process. So the historical evidence shows the loss given default is lower for loans with higher value, more liquid, and senior collateral. That's why you see that when we talked about loss given default, we're basically saying, we're saying in case of default events, so in case default happens, two things are likely to happen. It's either we're going to recover the money that is outstanding, or we're not going to recover the money that is outstanding. So the portion that we're not going to be able to recover of the total loan, so the portion that we're not going to be able to recover is basically what we refer to as the loss given default. Are we on the same page so far when it comes to the definition of the exposure at default, the probability of default, and the loss given default as well? Are there any questions there? Another factor would be default correlations. And here they say, default correlation measures the possibility of one borrower to default on its obligation and its effect on the of another borrower to default on its obligation as well. So this default dependence is due to common and diversifiable factors. So default events are not independent. Defaults may occur in clusters due to correlation across sectors, regions due to common systematic factors. So correlation of default adds to the credit risk when a portfolio of loans and advances is in consideration vis-a-vis single loans or advances. So when many borrowers default together, correlation effects becomes more pronounced. Thus, the correlation contributions need to be considered carefully in the risk measurement and management of credit portfolios. Just like what we saw, we were basically saying that if two portfolios are likely to have a situation where when one defaults and the other one defaults as well, then it basically means that our correlation risk is basically high, and we need to try as much as possible to limit that correlation risk. So which means default correlation is basically the same thing, where we're saying that if one asset A defaults and asset B defaults at the same time as well, either because they are in the same pool or because the default of one affects the default of the other one as well. It basically means that your correlation risk is basically too high. And the idea here is to have a situation where your correlation risk is going to be closer to -1 as much as possible as well. So here they say correlation risk, credit risk is generally measured as a risk on individual counterparty transaction or default risk and portfolio risk. The credit risk of a bank's portfolio depends on both the external and internal factors. So the elements identified for credit risk are shown in chart 1.1, where they say, so in this case, when you look at the key drivers of credit risk, they're basically saying that credit risk can be coming from portfolio risk, or they can be coming from transaction risk. If it's coming from portfolio risk, this is where you look at, for example, concentration risk, and this is where you look at intrinsic sector specific risk as well. Then when it comes to if it's going to be coming from transaction risk, this is basically where it can be due to downgrade risk or recovery risk, or it can be due to default risk as well. So is there any question when it comes to the breakdown of chart 1.1, which shows you the breakdown of the key drivers of credit risk as well? Are there any questions? Are there any questions?
I just wanted to ask if you can elaborate on the intrinsic risk. What does it mean? What is it? Intrinsic sector specific risk. Yeah.
So when you look at intrinsic sector specific risk, right? This is basically where you look at the sector in which your investments are falling under as well. To say, so how of your overall portfolio, how much of your portfolio is invested in a particular sector as well. Mainly because if your investments are going to be coming from the same sector, for example, it basically means that you are going to be having a situation where the risk factors, when they affect a particular sector, is going to be affecting all your investments, which are also going to be falling within that particular sector as well. Like, for example, let's say, for example, you look at investing in mines, right? If you look at the mining sector, remember you can either invest in coal, you can either look at investments in gold mining, you look at investments in diamond mining. But if there's going to be risk factors that are going to be affecting the mining sector as a whole, It basically means that if all your investments are invested in the mining sector, although you are investing in gold, you're investing in platinum, you're investing in what? It basically means that if there's going to be anything that affects that particular sector, it basically means that your risk is going to be high of the overall, your portfolio risk, overall portfolio risk also going to be high as well. Like for example, where they end up putting in place, or the government might put in place laws that restrict certain activities of the companies within the mining sector, or maybe the government might end up increasing taxes specifically targeted towards what? The mining sector as well. It basically means that your investment is going to be negatively affected, or maybe the government might put in place laws, like for example, to say, we want you to be able to do certain things within the community, because remember, the more you do certain things within the community as well, this is where you find that the business are also going to be negatively affected, because they could be using that money they could be retaining that money as profit, but they're now going to be obligated to use that money to benefit the community as well. So this is why you see that there's always going to be a constant friction between what the government says and what the sector also says as well, because it's all to do with issues of what? Of profits as well. So when you look at the intrinsic sector specific risk, you're basically saying that what are the risk factors that are going to be affecting a particular sector, which ends up affecting your overall portfolio? Because if you're having a situation where your investments are invested in a particular sector, it basically means that if there's going to be any changes within that sector that affects you, it's going to end up negatively affecting what? The performance of your overall portfolio as well. Are we on the same page?
Okay, no, I got it. I understand.
All right. Are there any other questions? Any other questions, or any question regarding these different risks that are falling under portfolio or transaction risks? Any questions? So moving on. All right, can we take a few minutes break until 12:30, and then at 12:30 we move on to borrower level or versus portfolio risk as well. So can you take a few minutes break until 12:30, and then on 12:30 we look at borrower level or portfolio risks. All right, can we continue? On the next section of the chapter, we look at borrower level risks versus portfolio risks as well. So here we're saying, when making credit decisions during lending, there is always a risk that the borrower might default on its contractual obligations to repay principal and interest. So the risk factors that are unique to the borrower causing them to default are called borrower-specific default risks. So the borrower-specific risk can be measured by using credit rating and tracking the borrower rating movements. Then portfolio risk arises from the composition of or concentration of a bank's exposures to many assets to various sectors. So systematic factors are the external factors that affect the fortunes of a proportion of the borrowers in the portfolio. So concentration risk results from having a number of borrowers in the portfolio whose fortunes are affected by a common factor. So this common factor is called correlation factor. So systematic factors correlate the portfolio risk to changes in macroeconomic environment. Like for example, changes in GDP growth, unemployment rate, and also fiscal deficit as well. So credit risk modeling is being extended into evaluating portfolio risks, especially in the areas of commercial and industrial loans, management of asset allocation in the loan portfolio, and portfolio monitoring. So the portfolio risks is influenced by the idiosyncratic borrower-specific risk and external systematic risk. So the internal borrower-specific risk can be managed by adopting proactive loan policy, good quality credit analysis, prudent loan monitoring, and sound credit culture. So the external risk factors can be managed by diversifying the portfolio, correlation analysis, setting norms of borrower and sector limits as well, and through effective loan review mechanisms and portfolio management. So when you look at borrower level risks and portfolio risks there, we're basically saying so this is the portfolio. So this is the portfolio where the bank's portfolio is made up of loan A, loan B, loan C, loan D, loan E, loan F. Let's say it's made up of these loans as well, right? So which means in this case, when you look at portfolio risks, before we go to portfolio risk, when you look at borrower risk, this is the risk that is emanating from your loan that you've given out to customer A. Like, let's say, for example, we are saying for customer A, you gave them a loan of 20K. Customer B, you gave them a loan of, let's say, 10K. And customer C, you gave them a loan of 5K. And the same with customer F, a loan of 5K. And customer E, you gave them a loan of 10K. And customer D, you also gave them a loan of let's say 10K, right? So which means in this case, we are saying your overall value of your portfolio in this case is 60,000. But to make up this overall portfolio value of 60,000, your portfolio is made up of loans that you've given out to these customers with these values as well. So when you look at borrower level risk, this is where you're now going to be You are specifically looking at each customer to say, how much is our risk exposure here? So you're specifically looking at each customer and saying, how much is our risk exposure here to customer A? How much is the risk exposure to customer B, customer C, customer D? So when you look at these customers individually, that's when you're now looking at what the risk exposures. That's where you look at what borrower level risks. Now, when you look at portfolio level risk, this is where I'm going to say, how is the overall risk exposure of the overall portfolio, which takes into account all these customers, and also the correlation between these customers as well. So that's the main difference between portfolio risk and borrower level risk. Are we on the same page? Any questions? Anyone lost? So looking at that, moving on to the next section, we look at importance of management of credit risks in banks. So the importance of management of credit risks in banks. And here they say, I'll read from the beginning of that paragraph. And here they say, lending is the major activity of banks, and thus is the constant credit risk faced by them. Adequately managing credit risk in a bank is critical for its long-term survival and growth. So credit risk management is important for banks because of the following reasons. And the first reason that they give for credit risk management for a bank is to do with the issues of what? Market realities. And here they say, the structural increase in non-performing assets, where they say, these result in massive credit downs and losses, massive write-downs and losses. So the increase in stressed assets badly hit the banks as provisional and capital requirements go up sharply, which squeeze their profit level. So to understand this better, they talk about subprime loans, where they say subprime loans in the housing sector were one of the most important causes of US financial crisis in 2008. And recently, a sector-wise analysis demonstrates the challenge of stressed assets in the Indian banking system intensified during 2013 and 2014 due to the rising incidence of loan defaults in the infrastructure, retail, small-scale industries, and agriculture. So this has resulted in a slowdown in the system-level credit growth as well. So one of the reasons why you need to do credit risk analysis basically is to do with market realities, where we're saying that over time, the market conditions change. And if the market conditions change as well, it basically means that you are continually going to be faced with what? Non-performing assets. And as I showed you on the accounting equation, where we say that on the asset side, if there are going to be losses, who's going to be absorbing those losses? We expect the capital by the owners of the business to absorb those losses. If there's not enough capital to absorb those losses, then it basically means that there's going to be affecting the depositors. And then the ripple effect from there is going to risk what? The chances of the bank even being forced what? To close down as well. Then the other market reality looks at higher concentrations in loan portfolios, where they say overexposure to a borrower or related group of borrowers can pose risks to the earnings and capital position of a bank in the form of unexpected losses. Higher loan concentration makes banks vulnerable during economic downturns due to incidents of clustered defaults. And we've already explained this as well. Then the next one looks at capital market growth, where they say it produces a winner's case effect due to the increased competition, as many companies have alternate channels to raise funds as well through the bond and equity instruments. So which means because companies are able to grow, because they are now having more and more sources of capital as well, it basically means that this is basically the market realities as well. That is also basically going to be causing what more the credit risk of the credit risk of the banks to be increasing in reality. The other factor looks at increasing competition, where they say higher competition among banks to book big loans, leading to lower spreads and net interest margin. So this is primary concern for top management in banks. Reason being, due to increased competition, when the profit margin goes down, it means for the bank to remain competitive and for the bank to remain profitable as well, they need to make sure that they also keep a very strong hold on their what? Costs. Which also means, what does that mean? It basically means that they also need to make sure that they keep a very strong hold on what? One of the costs that they're going to be worried about is what? Default, which is basically losses in their what? In their loan, in their loan books as well. So which basically means that as the profit margins are becoming lower because of high competition, banks are forced to charge a lower interest. Remember we said, oh yeah, we already have this formula. Remember we said the interest, which is the price of credit for that is going to be, which is basically the price of credit that is charged by the bank, is made up of the risk rate of return. Remember, the risk rate of return, in most cases, the proxy for the risk rate of return is basically the return on government securities. Like, for example, treasury securities as well. Like, for example, e.g., T-bills. So that's the risk rate of return. Then over and above the risk rate of return, when they're looking at the pricing of the credit security as well, they have to take into account the risk premium. But now, because of increased competition, they might be squeezed on how much risk premium they need to charge the customer to properly price the credit asset as well. So because of this, it basically means that the bank is now going to be running on very narrow profit margins in order to keep up with competition. But because they're not properly pricing this risk premium, it basically means that if there's going to be any default on the customer side, they are not going to be making enough profits to absorb that default as well, which basically means that it's going to end up negatively affecting the runnings of the bank as well. So that's another market reality that the banks have to take into account when it comes to management of credit risk as well. Are we on the same page? Any questions? Any questions so far? Moving on, another market reality is declining and volatile values of collateral. And yet they say a decline or volatility in the collateral value warrants a greater amount of credit risk due to uncertainty in loan recovery. So which means here they say both the Asian crisis and the US subprime crisis as well have revealed that collateral values fall faster than the borrower's increased chance of default. So the value of collateral also goes down drastically due to increase the increase in chance of default as well. So here, when they talk about the declining in the value of collateral, a bank is given out a loan to a customer. The customer pledges a particular asset as collateral. Now, when there's a market downturn and default occurs, the bank might now want to sell this asset so that they recover their money as well. But what we have seen during the financial crisis is that even as the banks try to sell certain securities to recover their money, because everyone else is selling in the market, what is going to happen? Those securities are going to be fetching a lower value. So which means if the collateral was offered, if the outstanding amount, let's say for example, the outstanding amount was 100,000. And initially, when we valued the collateral, we said the collateral was worth 120,000. That was offered by the customer. It means we are happy that if the asset, which is the collateral, is worth 120,000 and the customer is owing us 100,000, we are happy that even if the customer defaults, we can sell the asset and recover our 100,000. But now, during periods of financial crisis, because everyone else is selling those assets in the market as well, what is going to happen? The force of demand and supply detects that when there's an oversupply of a certain security, what is going to happen? The value of that security goes down, which means even though initially we said we were going to be able to sell this security for 120,000, we might end up selling it only for 90,000, which means if you sell it for 90,000, but the customer is owing us 100,000, it means there's still that 10,000 that needs to be recovered, which means that in this case, that's the market reality where which is going to end up affecting what? The credit risk of our portfolio as well. Are we on the same page when it comes to this point? Any questions? Next, we look at growth of off-balance sheet credit products. And here they say, the rapid growth of off-balance sheet products like the various structured products, for e.g., collateralized debt obligations, credit derivatives, etc., to trade the credit risk positions has heightened the need for more prudent bank regulation. Now, these off-balance sheet products, like for example, when you come to the derivative as well, they grow over the years. We have seen that the derivative market has been growing, substantially outpacing the actual securities market. So because of this, we find a situation where even if you are going to be if the bank invests in these derivatives as well, you might find that if the bank does not fully understand the credit risk of these derivatives, what is going to happen? It basically means that during market downturns is going to result in what? Losses to the banks as well. Like what we saw during the 2008 financial crisis, where even those, for example, collateralized debt obligations that were where the mortgage loans were repackaged into CDOs, which is collateralized debt obligations, and then these investments were now sold to other institutions as well, or maybe, for example, to other banks across the world as well. So they were investing in these off-balance sheet securities, because remember, you're not buying an asset. You're basically buying an investment where there's no underlying asset and that is basically invested in it as well. So which means in this case, if the participants don't fully understand the risk exposure of this particular asset as well, it basically means that there's going to be a huge risk that there is going to be default on the underlying security, which they don't understand. And if there's default on the underlying security, it's going to end up affecting the value of this off-balance sheet security as well, hence increasing credit risk. So that's basically another market reality. And if we have seen, if you look at it from 50 years ago until now, you will see that there's been a big exponential growth in these off-balance sheet securities as well that are being traded across the world. So another factor that they also take into account, which also looks at effects of credit risk as well, is where we look at changing regulatory environment, where they say the Basel II and the Basel III, when you look at the Basel II and the Basel III as well, and they say the regulatory compliance enables a bank to establish a risk management framework, set appropriate control process, and improve corporate governance framework. So the regulatory compliance is involuntary in nature and enhances a lot of values to the organization as well. So another issue that has affected the credit risk exposures of banks as well is the changes in what the regulatory environment as well. That's why you see that even if, especially if you look at what is happening currently in America, remember there's been the progression of the Basel Accords as well. But what you also find over time is that there are those, especially banks, there are those banks which basically try to lobby for deregulation, where they're basically saying that this progression of the Basel Accords, there are certain conditions that they are basically imposing, which are going to be affecting their profitability as well. So what do they do? So it basically means that they lobby for deregulation of some of these conditions as well. And so now you find that if there is going to be deregulation of this, which results in negative changes in the regulatory environment as well, it basically means that the banks might make money, but at the same time, the credit risk is going to be increasing. So now so it basically means that there is now a fight between the balance between increasing the regulatory requirements, which also ends up affecting the profitability of the banks, or decreasing the regulatory requirements, which might increase the profitability of the banks, but at the same time, increase the credit risk that the banks are also going to be facing as well. Another issue to consider is institutions' risk vision, where they say capital is a scarce resource and need optimal utilization. So the success or return in a project of a financial institution is observed by its stakeholders. So if the financial institution is engaged into new business and expanding its existing business, it requires capital as a buffer against what? Unexpected risk of losses. Like what we said, the more the risk the bank is going to be taking, the higher the capital requirement that they also need to maintain within their book to absorb the potential losses as well, especially when you look at unexpected losses. Then they also look at improve risk-adjusted returns on capital and risk-based pricing. And here they say a risk-adjusted performance measurement framework would guide it to link its business growth targets, risk management processes, and shareholder expectations as well. So these are some of the issues that also ends up affecting the credit risk of the bank overall. Is there any questions regarding some of the issues that have changed that also affect the credit risk of a bank? Any questions?
The Basel report, what's the purpose of it?
Sorry?
The Basel report. So what's the purpose of that report?
All right, the Basel Accords, the idea behind the Basel Accords goes back. Remember, I explained before where we say the bank's accounting equation says your assets is equal to equity plus liabilities, right? So when you look at the banks, the Basel Accords are basically saying, remember we said here, this is where the banks are going to be either giving out loans or investing in securities there, right? And what are we worried about on the asset side? We are worried that in pursuit of returns, the bank might suffer losses, isn't it? Now, as the bank might suffer losses, we're now going to be saying, how do we now determine to see exactly how much capital should be kept within the bank to absorb these losses? So why are we worried about the capital to absorb these losses? Because we said some of our depositors there is basically the money that the bank is owing, but most importantly, the money that is being given to the bank by depositors, isn't it? So if there's going to be potential losses suffered here, we need to find out exactly how do we ensure that we have enough capital to absorb these losses. Are we on the same page? So
Yeah.
the Basel Accords are basically saying, how do we calculate how much capital to maintain so that we are able to absorb these losses? That's why you see that in simple terms, your capital requirements, I'm saying in simple terms because remember, it will now depend on exactly which Basel Accords you're looking at and how the adjustments are as well. Because remember, continuously, they're making adjustments to this capital requirement calculation as well. So your capital requirement is going to be your risk-weighted assets multiplied by, in South Africa, it will be 10%. So how do we determine these risk-weighted assets? We're basically saying these assets that you're investing in, depending on how much risk you're taking, so to cover for these potential losses, how much capital do you need to maintain? 10% of your risk exposure here has to be the capital requirement, so that we have enough capital available to absorb these potential losses. So that's the main idea. I'm saying in simple terms because it becomes more complicated now, because in calculation of this capital in the calculation of this risk-weighted assets as well, there are different developments that have been done in actually calculating this capital. Because remember, it's not only from a Rsk4804 perspective, we are more worried about credit risk, but the banks are not only going to be looking at credit risk, they have to take into account other risk sources, like, for example, market risk as well. Are we on the same page? So the main idea behind the Basel Accords is to find out exactly how much is the capital requirement we need to maintain here, so that from our risk exposures in our assets, so that we're able to, in generating returns there, we need to make sure that we have enough capital available to cover or cater for these potential losses as well. Because if we're able to have enough capital to cater for these potential losses, the more we're able to guarantee the continuity of the bank as well. Are there any questions? Any questions? Anyone lost? Can you move on? On the next section, we look at the role of capital in banks, where we look at the difference between regulatory capital and economic capital. Now, before we move on into this section, in simple terms, when you look at the regulatory capital of the bank, remember we said here, when it comes to the capital of the bank, when it comes to the capital that the bank needs to maintain, we're saying we need this capital to absorb these potential losses, right? So we need the capital to absorb these potential losses. So when you look at regulatory capital, we're basically saying, according to regulations based on the bank's supervisors. Remember, the bank supervisors would be the central banks for each country, right? So according to the what is the minimum capital requirement that is needed to make sure that we have enough capital to absorb losses according to the bank supervisors. So according to regulation, or by regulation, how much capital should be maintained within the bank? So that's basically what they mean by what? Regulatory capital in simple terms. But now, how it differs from economic capital is where the bank is now going to be saying, according to our own calculations, in order to mitigate these potential losses, how much capital do we need to maintain within the bank's bank system? So that's basically the economic capital. So the economic capital is basically based on the bank's internal risk assessment, and the regulatory capital is based on what the bank supervisor says you must maintain as minimum capital within the bank system as well. So you'll find that there's always going to be a back and forth between regulatory capital and economic capital. That's why you see that it normally regulatory capital is higher than economic capital. So normally, so the lower the capital the bank needs to maintain within its books, the more it can take that capital and invest it in make more money as well, right? So banks are now caught between trying to keep capital within the bank system so that we absorb potential losses. But if we keep too much capital within the bank system as well, in case of potential losses, it basically means that we are having money that we're holding that we could have been using to make more money for the bank as well. So that's basically where the dilemma of the bank will be coming in as well. So which means in most cases, you find that the regulatory capital is usually higher than the economic capital. So that's why you see that because normally the regulatory capital is usually higher than the economic capital, what do banks do? They try to now lobby to try to lower the requirements of this regulatory capital so that because the more they lower this regulatory capital, the more they're able to make money because what they're trying to meet this economic capital as well. So that's basically why you find that there's a stark difference between the regulatory capital and the economic capital as well. Are we on the same page? Any questions between when it comes to the general distinction between the two? Yes, when we go through this material, they start going in depth, and to avoid any confusion, know the basics. Because if you know the basics, basically means that no matter what terminology that they give you, you just know that the basics is the regulatory capital is basically what the bank's supervisor is saying is the minimum capital or is the calculation for the minimum capital that the bank needs to maintain. And the economic capital is basically where the bank saying, according to our own internal assessment, this is basically how much our risk-weighted assets should be so that, and this is how much we should maintain within the bank as well. Just give me a second. Are we on the same page so far? Any questions? So looking at this, they say, so when you look at the role of capital in banks, when you look at the role of capital in banks, they say the difference between regulatory and capital and economic capital. They say while housing prices are increasing in the US market, consumers were saving less and both borrowing and spending more. So easy credit and the belief that the house prices would continue to appreciate had encouraged many subprime borrowers to obtain adjustable rate mortgages. So the credit and house price explosion led to a building boom and eventually to a surplus of unsold homes, which caused the US housing prices to reach its peak and then begin declining in mid-2006. So refinancing became more difficult once house prices began to decline in many parts of the US. That resulted in higher loan to value ratios. So borrowers who found themselves unable to escape higher monthly payments began to default. So the US subprime crisis has thus revealed the vulnerability of the financial institutions due to interaction between falling house prices and homeowners' home equity lines of credit. So the fall in house prices led to a sharp rise in mortgage defaults and foreclosures, which had increased the supply of homes on the market and caused house prices to fall further. So the rising unemployment rate at a later state has attenuated the trouble for the industry, and the economy was caught under a vicious cycle. So to break this trap, the US government needed to step in with capital injections as a revival measure for banks and the entire system as well. So when you look at the vicious cycle of the capital problem, they're basically saying that when you look at, you can start from anywhere, where if you look at the increase in supply of homes for sale, remember the laws of demand and supply basically says that if there's an increase in supply of homes for sale, it means that there's an oversupply of homes, which means in that case, there's a falling home price as well, which means that this low falling home price as well means that this results in a high loan to value ratio. Then this results in limited options to refinance the houses as well. And then this also results in ARM resets at higher rates, which basically means that these interest rates that are being charged on these mortgages as well, they're going to be now charged at a higher rate because the risk is also increased as well. And if the interest rates increase in the market, what is going to happen? Not everyone is going to be able to afford these homes, which means that you're also going to be expecting increase in defaults. And as there's an increase in defaults as well, it basically means that you're also expecting to be having more foreclosures in the houses market, when it comes to the houses as well, and the cycle would continue like that as well. And it will be very interesting to see exactly. Remember, they just increased the repo rate by about 50 basis points as well, which basically means that the cost of servicing a home loan is expected to increase. So it will be very interesting to see exactly what the ripple effect would be when it comes to the affordability and potential defaults on home loans as well. So are we on the same page when it comes to the vicious cycle of capital problem, especially when you look at mortgage loan financing? So looking at this, so here they say, to break this trap, the US government needed to step in with capital injections as a revival measure for banks and the entire system as well. That's why you see that there was a lot of bailouts that were done post 2008 financial crisis as well. Then they also say it basically means a bank can also be trapped in such a vicious situation and hence veer towards bankruptcy due to a rise in bad quality of assets. So a significant deterioration of asset quality will increase the risk-weighted assets and provisioning requirements and will thereby eat away its capital and profit. So in order to assess the overall capital adequacy ratio of the bank, the risk-weighted assets are added up and then compared with the total available capital. So a fall in the capital adequacy ratio will reduce the bank's overall rating and erode the retained earnings due to the rise in funding costs and will further worsen its solvency position as well. So that's why they say the banks can also find themselves what being caught up in this particular vicious cycle as well. So here they say, recently, the Financial Stability Report of Reserve Bank of India has raised concern over the significant erosion of the capital and profits of India's banks due to rise in bad debts and restructured assets. So the NPA and restructured loans together increased to 11.1% of the total advances of the by the end of 2014. Most of the stressed assets were in 5 subsectors: the mining, iron, steel, textile, infrastructure, and aviation, that together constitute about 25% of the bank loans in India. So in analysis of table 1.1 containing quarterly data by banks shows that the gross non-performing assets have been increasing continuously since March 2012 for public sector banks and old private sector banks as well. So they give us that information in the table below as well, this particular table. But I don't think for exam purposes, we need to worry much about this particular table. That's why I'm going to skip it for now. So here they say, when on the next paragraph, capital acts as a buffer to absorb future unidentified losses that protect the liability holders of a bank. So it plays the role, which is basically the depositors, the creditors, and the shareholders as well. So it plays the role of a safety belt in the car as a protection against any accident. So the concept of economic capital differs from rated capital measure. So the Basel Accord uses a 2-tier concept of rated capital, where core tier 1 consists of retained earnings and equity capital and free reserves, and then tier 2 includes mainly borrowings. So internationally, the total capital adequacy ratio is not allowed to fall below 8%. So that's why you see that internationally it's not allowed to fall below 8%, but from South Africa perspective, we use 10% as well. So which means that's why you see that here, when I looked at the calculation of the capital requirement, I said it's equals to the value of your risk-weighted assets multiplied by 10%, because in South Africa, we use 10%. We don't fall back to 8%. We use a 10% in the calculation of what capital requirement as well. Although internationally, they're basically saying that it should not fall below 8%. So in South Africa, we use 10%. That's why I use 10% in the calculation of the capital requirement there. So here they say, in India, banks are under obligation to maintain minimum capital to risk-weighted asset ratio of 9%, and are encouraged to maintain a tier 1 of CRAR, which is basically the capital to risk-weighted asset ratio of at least 7%, while regulatory capital is the mandatory capital. The economic capital is the mandatory capital. The economic capital is the best estimate of the required capital that the financial institution is used internally to manage their own risk. So a proper economic capital model can enable the bank management to anticipate and safeguard themselves from potential problems. So economic capital is the actual amount of risk capital necessary to support the risk in the business taken on. So it is purely a notional measure. So it is purely a notional measure of risk capital, but not of capital held. It does not involve the flow of funds or charge against profit or loss. However, the bank must know the inherent risks in their business and must assess the unexpected losses that could happen. So economic capital is generally used to evaluate the risk-adjusted performance. And moreover, economic capital, which is the EC, measure typically takes into account a portfolio diversification benefit, which is not generally considered in the regulatory capital estimation. So the major difference between economic and regulatory capital are nicely summed up by Michael Arten. And yet they say it was further emphasized that regulatory capital cannot be a substitute for economic capital, since capital goals of supervisors and institutions are different. So risk-taking is a natural part of banking transactions, and banks are in the business of incurring, transforming, and managing risk. So they are also highly levered. So the regulatory agency is responsible for creating a sound financial environment and level playing field by setting the regulatory framework where the supervisory agency monitors the financial viability of banks and checks compliance with regulations as well. So it basically means that there is a stark difference between economic capital and regulatory capital. So please take note that there is a stark difference between economic capital and regulatory capital as well. So is there any questions when it comes to the difference between economic capital and regulatory capital? Are there any questions? Can we move on? On the next section, we look at credit risk management framework. And here they say, I'll read from the beginning of the paragraph there. And here they say, a financial institution or bank must know which, when, and how much credit risk to accept to strengthen bottom line, and also conduct proper evaluation of the default risk associated with borrowers. And in general, protection against credit risk involves maintaining high credit standards, appropriate portfolio diversification, good knowledge of borrowers' affairs, and accurate monitoring and collection procedures. So here they say, in general, credit risk management for loans involves the first one being borrower selection, where they say this is the selection of borrowers by assuming proper rating models and the delegation of rules that specify responsibility for taking informed credit decisions. And the second issue is limit setting, where they say set credit limits at various levels to avoid or control excessive risk taking. So most banks develop internal policy statements or guidelines setting out the criteria that must be met before they extend various kinds of loans. So when it comes to credit limit, you're basically saying how much or what is the maximum amount that we can give out to a particular customer as a loan as well. Then they also look at portfolio diversification, where they say banks spread their business over different types of borrowers, sectors, geographical regions in order to avoid excessive concentration of credit risk problems and conduct proactive loan portfolio monitoring. So in order to monitor and restrict the magnitude of credit risk, prudential limits have to be laid down in the loan policy. So the portfolio quality is evaluated by tracking the migration of borrowers from one rating category to another under various industries and business segments, etc. Then they also look at risk-based pricing, where they say implementation of a more systematic pricing and adaptation of the risk-adjusted return on capital framework enhances the organization value. So a benchmark rate reflective of lending costs of the bank, which can be used with an appropriate markup to lend to various categories of borrowers. For example, a bank can formulate an interim risk pricing policy to price its borrower accounts based on the rating category. So a robust credit risk pricing model needs to generate a credit term structure consistent with empirical properties. So banks should be looking to formulate pricing models that reflect all the costs and risks that they undertake. So the pricing model should be realistic, intuitive, and usable by the business people as well. So when you look at the risk-based pricing, this is basically where you're now trying to take into account what? The expected losses as well. So they also go on to say, credit risk management framework should enable the top management of banks to know which, when, and how much credit risk to accept to strengthen the bottom line. So it consists of the following steps. And the first one that they discuss in this case is identify the risk, which means data capturing and identifying the drivers through various rating models. Then the next step would be measure the risks. And in this case, they say you need to be able to assess in terms of size, timing, and probability for which the bank should have proper systems and tools in place. And then the third one is manage or control the risks as well. And in the end, they say, based on these measures, various reports can be generated that will help the management in avoiding, mitigating, offsetting, and diversifying the credit risk in various portfolio segments as well. And then the next step would be monitor the risks, where they say this is basically where you look at the categorizing significant changes in risk profile or controls as well, so that you're able to now check to see exactly which assets should we keep on our books and which assets should we either decide to sell as well. So is there any question regarding these different steps as well? Are there any questions regarding any one of the steps? On the next section, they also discuss and they say the sound practices of credit risk management specifically address the following areas: establishing an appropriate credit risk environment, operate under a sound credit granting process, maintaining an appropriate credit administration, measurement, and monitoring process, and ensuring adequate controls over credit risk as well. Then they also go on further to say, when you look at the credit risk management process, they say the credit risk management process in a bank should aim at taking informed credit decisions, setting provisioning and reserve requirements against current or future levels of profitability in order to measure risk-adjusted performance, establishing minimum pricing levels at which new credit exposures to an obligor may be undertaken, pricing credit risk instruments and facilities, measuring the regulatory capital charge following the standardized or IRB approaches, and measuring the actual risk capital or economic capital, and calculating the risk-adjusted performance measures such as the risk-adjusted return on capital as well. So these are basic. So in this case, these are basically what the credit risk management process should aim to achieve when it comes to a bank as well. Is there any question regarding what we've covered above? Any questions? So remember, our learning outcomes, they were asking us to cover the material up to page 13, and we have done that for chapter 1. So for chapter 1, we're expected to cover the material up to page 13, and we've done that so far. So in the next class, please take note. In the next class, we are going to remember going back to our learning outcomes for learning unit 1. They asked us to cover this chapter 1, which is what we've covered already. So we're going to look at chapter 2 based on the other book. I don't think it's gonna be that long. Then when we're done with this, we have already covered chapter 2 of C.B. Joseph already. So we have already covered chapter 2 of C.B. Joseph, which means in the next class, we're going to be covering this chapter 2 of this book. Because for chapter 2 of this book, they're asking us to look at 2.1 and 2.3. That's basically what they're asking us to cover. Then, which means in the next class, We are going to quickly finish learning unit. We are going to quickly finish learning unit 1. Then we move on to learning unit 2 as well. So remember what I said. Moving on, what we're going to do is the material that was covered last year, we are going to rearrange that material to meet the sequencing that the lecturer is asking us to cover as well. So we're going to make sure that we rearrange the material to meet the new sequencing that the lecturer is asking us to cover. Then what we're also going to be doing as well is that we're also going to be adding on the other sections that are covered in the other 2 textbooks as well. Because previously, we were using the other 2 textbooks as supporting textbooks to CB Joseph, basically. So what we're going to do now is that we're going to be covering exactly according to the study guide of what the lecturer has asked us to do, because it seems like they are putting more emphasis on us being able to cover the other material. Although, if you look at it effectively, most of the things that are covered in these other books as well, it's things that are also covered in CB Joseph's, although given in different parts of the textbook as well. So there's totally nothing new from things that were covered in CB Joseph. Just here and there where they're going in detail when it comes to certain concepts as well. So please expect that by Tuesday morning, the platform for Rsk4804 would have changed, because we're going to be rearranging the chapters according to the sequencing of the new study guide for 2023 as well. So please make sure that you take note of that. Are there any questions? Any questions? Anyone lost? All right, so we'll end here today. I know that we are now on stage 4, and not everyone is able to have devices that are able to run for the duration of the load shedding period as well. So we'll make sure that we will try this video of what we covered today by Monday. By midday on Monday, the link to the video will be shared as well. So by midday on Monday, the link to the video will be shared, because we know that not everyone is going to be having the devices that are able to run for the duration of the load shedding period as well. So because of that, we'll try and ensure that the videos are uploaded as soon as possible, so that even if you miss part of the class, or even if you miss the whole class as well, you are able to quickly catch up on what you have missed as well. Because due to load shedding, we know that not everyone is going to be having devices that are able to run for the full duration of the class as well.
Can you this textbook that you used today on the LMS? Because you only added 2 books there.
If it's not there, I'll update it. But I do have these books already. I'll update. What I'll do is that I'll communicate on the groups when I've updated everything. But the books are there.
Okay. Okay, bye.
All right. Are there any other questions? All right. If there are no questions, enjoy the rest of the weekend.